There are certainties in life, and tonight we're going to talk about some of those financially. I'm your host, Joe Clark.
And I'm Angi Kinser.
Hey, welcome to Consider This. We're going to do our best to have as much fun tonight as we possibly can, talking about money, the tax code, and again, Angi, things that are certain in your life.
Certain in life. And so we always think of death and taxes when we talk about that. So I have a little multiple choice.
Uh-oh.
Who said it question
Multiple
for you.
guess.
Multiple.
That's what I used to tell
no,
us. I used to tell the students that at Purdue. It was multiple guess, not multiple choice.
Well,
but
this is something you probably know something about, but there are a possible 4 answers, and you're going to guess who said the famous quote that there are 2 certainties in life that are death
Mark
and
Twain.
taxes. The first option is A, Mark Twain, B, Christopher Bullock, C, Benjamin Franklin, or D, Daniel Defoe.
My guess is they probably all said it. Mark Twain was the first one I know quoted to say it, and I believe he did it actually under Samuel Clemens.
In 1884, Mark Twain wrote, I changed publishers, and sure as death and taxes, I never will again. But before him, in 1789...
that'd be Ben Franklin.
Benjamin Franklin wrote, "The world is in this world, nothing can be said to be certain as death and taxes." But before him, in 1726, Defoe, who wrote Robinson Crusoe, said, things as certain as death and taxes can be more firmly believed. And then before him, the first person was Christopher Bullock. And in 1716, in his book called The Cobbler of Preston, he wrote, "'Tis possible to be sure of anything but death and taxes."
So I was right. It was all 4.
It was all 4.
But the most famous by far and away would be Samuel Clemens because he's closest to us in age.
He's closest to us, so that's why. But I just thought I found so much information on it, and I couldn't believe how many people have researched
So
that.
here's the deal, folks, ladies and gentlemen. As we go through our financial journey, and we're going to talk about that tonight on the show, obviously, but as we go through our financial journey, you need to be prepared for the fact that you are going to pay taxes. And one of the biggest mistakes that I see people make financially is to ignore that they're going to pay taxes into the future. And so what happens is your tax rate is not stable. It is a variable depending on who's in the White House, who's in Congress, who's in the Senate. It changes all of the time, and it changes dependent upon your income and what type of income. So if you've missed that, make sure you go back and read or listen to some of our other shows where we've talked about is all income taxed the same way. Hey, you're listening to Consider This program. I'm your host, Joe Clark, along with Angi Kinser. Give us a call at 800-928-4001. We'll be right back. Hey, guys, welcome to the show. For those of you that are streaming along with us, happy to have you. Really, really appreciate you taking the time to do this. Don't forget if you got a question. And Angi, do we know who's receiving said question?
No.
Oh.
We don't.
So somebody's
it's
on
gonna
the
be a
other
surprise.
end of the email. It's a guest
I think a guest advisor.
advisor.
So I think maybe we'll try to guess by the end of the show who it was based on the
They're
questions.
going to have to give us clues.
Yes, clues.
We
You
need
hear
some
that?
hints as we go along. All right, what's our first conversation
We're going
about?
to talk about the death tax exemption and why it's easy to miss.
And you got really good questions. So here's the interesting part about the show, guys. Normally, I at least have an idea about what we're going to talk about. That didn't work out so well this week. So this is all, I'm blindfolded. As they would
Put
say.
up that blindfold. You have it right around your neck.
Yeah, there we go. As they would say in Sin of a Woman, I'm blind here. I'm blind here. So thank you, Al Pacino. Here we go. Casey. Well, good morning and welcome back to Consider This program. I am your host, Joe Clark.
And I'm Angi Kinser.
And Angi is here to quiz me, confuse me, and enlighten you. No,
That's my full-time job.
Yeah, yes, that would be. No, what are we going to talk about?
No, we're going to talk about the death tax exemption.
So what's death tax mean?
I'm going to assume it means after a spouse has died.
Hey, you came up with the title, so don't assume anything here.
Okay, so if you've lost your spouse, there's an overwhelming amount of stress, confusion, all of these things to address. Higher taxes is one of them, and I think people don't even really think about that. So do not overlook the possibility of locking in your deceased spouse unused federal estate tax exemption.
You just went to like 4 conversations in 20-word sentence.
I have faith in you. I think you
Yeah.
can.
All right.
I
So
think you can hit it all.
let's unpack this. So, all right. So you've got federal estate tax. If you have over, essentially, it's $11.5 million a piece right now that you can have, where you have a free exemption. So for the majority of people who are listening to the show, the majority of the people in the country, it doesn't even matter. You don't have it. So there's two terms you might want to write down if you're anywhere near that. Not necessarily terms you need to know. My students at Purdue needed to know them. If you're going to be a CFP, you need to know them. But there's the exemption equivalent and what's called a unified credit. Unified credit is the amount of prepaid taxes that the IRS essentially says you've already paid if you choose to use them. We'll be back to that in a second. Your exemption equivalent is at $11.5 million. It's essentially how much money can you have, get away with tax-free. Now, this is on the federal level, and you need to be aware of that. So your final estate tax return goes on tax form 706. And one of the key things, Angi, is that people fail to understand they need to fill out a 706. So when somebody dies, one of our families that we take care of, there's a little more than 1,100 of you guys now, when somebody passes away, we send a letter to the surviving spouse that recommends you file a 706 tax return. Now, I've had CPAs say you're wasting people's money, you're being stupid, It's about $250 to file a 706 for people who have no federal estate taxes that are due. And here's the deal. Somebody is going to hit the lottery, right? Now, I don't recommend you play the lottery. I don't play the lottery. But somebody's going to hit the lottery, or they're going to have an inheritance that they don't know about. And they're going to have a federal estate tax liability that is due. And if you do not file the 706, you don't get what's called portability. Portability came in under the Obama administration. And it's one of those things that essentially says, if you don't use your $11.5 million, Angi, and you and I are married, I get to use it for you. So we now have $23 million. Now, keep in mind, folks, the tax code sunsets December 31st of 2025. And we go back to wherever we were in 2017, starting January 1st of 2026. So the new administration in office has already pledged to try to reduce that amount closer to the $3.5 million. We'll see where they wind up, but a lower level. But Angi hit something that is much more key for most of you than what I just covered. I'm an estate planning junkie. I mean, this is part of my thing. The Financial Enhancement Group is able to be people's trustees. We take this part of our lives very, very, very seriously, and in that estate planning side. But what really happens to more people than that is that you get moved into what we call margin expansion. So if you think about the estate tax code, and those of you who are listening to us as opposed to watching us stream live on Tuesday nights from 5 to 6 p.m., what happens is the tax code is a series of stair steps where you work your way up. And the higher your income, the higher your step. So you have two different types of tax rates. You have an effective tax rate. The effective is your average that you pay across the board. The marginal is where your last step is. So, that may be 12%, maybe 10%, maybe 22%, maybe 37% if you're one of the fortunate that make enough money to be able to be taxed at that level, if you will. What happens when somebody passes away is your Social Security payments may be disrupted. You may get less Social Security because your spouse has passed away. But the amount of money that you have in your IRAs, for most of us, doesn't change. Something happens to me, Barb gets all of my 401k money, all of my Roth money. But instead of married filing jointly, she's now filing as an individual person. And suddenly the amount of taxable income that goes onto that return is great enough to move her to the next marginal bracket. That's what we call by margin expansion. And so you can have an increase in taxation just because somebody dies. And it's something that most people are unaware of.
Okay, we got a question. Is the estate tax exemption being reduced as well in 2026?
Everything reverts back to where we were in 2017. Will it be reduced? There'll be a lot of battle on that. Obviously, from where we are right now, there's a few Senate seats that are left out there, so we don't know the answer to that. There will be a drive to try to reduce it, and if nothing changes in 2025 or 2026 rather, it'll go back to 3.5 million, maybe 5 million. I can't remember where we ended up in 2017.
Some of the questions we've had before about filing after a spouse dies, how long can you file jointly after a spouse passes away?
So it depends if you have a minor child or not, and that's a great question, Angie. And I don't mean it disrespectfully, but there's a lot of people who do tax returns who don't know the answer
Right.
to this. So if you have a minor child, you actually get a free year. So if Barb and I had minor children and something happened to me this year, Barb could file a joint return through next year.
So,
We don't have minor children,
right.
24 and 28, one married.
Well, so there's
It ends at the end of this year.
the qualifying widow is a filing status.
It is.
Okay. So as long as you don't remarry, then whatever the time period is, 1 or 2 years
Right.
after.
So that marriage part is an important part. But here's where it really gets to be critical in terms of who you're dealing with that's helping you with taxes. And there's two parts of it. There's tax planning and there's tax preparation. And you really want to make sure somebody is helping you with the tax planning side. I was taught as a certified financial planner. One of the things they told us is that, hey, if somebody dies, you tell them to do nothing for 6 months because they tend to make very rash and emotional decisions. Hey, that's true. Something happened to Barb and I were married I said 33 years last year. I apologize. It's 32. I exaggerated, apparently. Feels like 50. No, just saying.
Well, now you just went back in the hole after you redeemed yourself for a second.
I spent most of my life there. So, but when you look at this and you understand how all of it works and it goes through, that married filing jointly issue is a huge issue, and you need to be aware of it. You need to understand how it works. You need to know what it means when two of you are filing a tax return. And you need to have that tax planning element that's done. And, I was on a call earlier today where there are two people that are really getting pretty lousy tax planning done. And it's going to cost them probably $100,000 in taxes, not because the reporting was wrong, but because the planning was wrong. That's sad. And there's nothing I can do to fix it.
After you lose a spouse, then so normally would your taxes go up or down?
It really depends. If you're on a pension and Social Security, where one of the Social Securities is lost, right? So the old saying is if something happened to you, you either get your Social Security or your spouse's, whichever is greater. That's sort of true, sort of not true. But usually you can keep a larger percentage of the check than what you could before. But you also have the other part of that Social Security that's gone. And so...
And your filing status, you're going from
you're
married to
you're
single.
now a single individual, and there's no way around that. So you've got some margin compression that may exist, but for most people it probably is a margin expansion, especially as we continue to go through the baby boom and we have more and more people that have more and more money in defined contributions, i.e. 401ks, 403bs, 457s.
So is there any other exemption for widows or widowers? I mean, anything else besides this that can help them tax-wise?
Any's a stretch, Angie. I could spend some time to try to figure out. Try to figure out what that is, but it is some of the biggest changes that came out of 17, and we actually talked about this on a planning call yesterday. is understanding how the medical deductions actually work in terms of those. So the last year of life, many times we have people with extended medical expenses, right? There's deductions that are there that people may be able to use, those kind of things. But it's a toughie. I mean, the bottom line is something happens to your spouse, the IRA, the 401ks, unless you're leaving them to the next generation, which is not necessarily a bad idea. We're doing more and more in that of our planning in terms after the stretch IRA was eliminated. Those are conversations that are coming up and need to be thought about.
And we definitely want to make sure any unused tax exemption by the, deceased spouse can be used by the surviving
absolutely.
spouse.
The key thing is to understand planning and understand if you lose a spouse, it's not the time to delay. It's as emotional and difficult as it is, you need to be doing planning now, quickly before the end of the year. 800-928-4001. Give Angie a call. Next Steps meeting. Look forward to meeting you. Hey, thanks for the question, guys. Appreciate it. We will continue to do our best to answer them. These are tough. This is not... Glad it's not Valentine's Day. This is these are tough conversations, Angie.
I know.
What were you thinking when you came up with
the theme,
topic? Yes.
the theme, certainties in life, death and taxes? Because when we look at the whole list of topics that we want to cover in a year, more than 50% of them have to do with death and taxes.
Great.
And it's something that all of our people deal with. So probably got to talk about it.
Okay.
So the next one is the death of your company the death of your retirement savings? We're going to talk about mergers and acquisitions.
This one is going to be, in my opinion, is going to probably surprise some people.
Okay.
So we will go there. Casey? Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angi Kinser.
Happy to have you guys along. All right, Ange, fire it up.
Okay, we're going to talk about, is the death of your company. So we're going to talk about a merger or acquisition. Also, the death of your retirement savings. What happens? So I know a merger can bring many worries and a lot of stress for an employee who might feel like, am I going to lose my job? What's going to happen to my retirement fund? So we're going to talk about how mergers and acquisitions impact your retirement plan if you're the worker caught in the middle.
All right. Fire away with your question.
Alrighty. What is, I guess to kind of start out, the difference between merger and acquisition, I guess the question is, what is stock versus asset?
One of the things, I run around with a lot of people who buy companies for a living.
Yeah.
They're all acquisitions. Merger is just a polite way of eliminating.
Well, but the difference might be between asset or stock purchase.
Well, okay, so you can get into that tax side. Here's the part that confuses people when you get into the pension side. So let's hit this real quickly because I just explained this to the planning team on Monday. So I've got 9 people that are on my planning team, and essentially what happens is every other week we come together to make sure that we all agree with a specific answer or topic or title in terms of where we are. That way we can make sure that people are learning and not just quote unquote selling. I just don't believe in that. And so somehow or another, and I get it, it's, some of them laugh at me, but when I taught at Purdue, I tried to teach people what mattered. And they said, Joe, it's Friday morning, it's 8:00. We had things to do on Thursday nights. And it's like, okay, I get it. So let's understand first if you're dealing with a company and you're dealing with a pension. So I think Andy or Casey can take us to the board. What you have over on one side is the pension liability. So, for those of you that are listening to the radio, I'm drawing. You can always go back to our website at yourlifeafterwork.com to watch this. But what you have is the pension liability. And over on the other side, you have the bad news bears. Whenever I say that, if you didn't watch the Bad News Bears, it means you're not as old as me. But where the coach would write, essentially the word assumed and then drew letters or lines under a few words, you're making assumptions, right? And those assumptions can get you into trouble. And so the assumptions are based on what you believe the total funds inside of the pension will create, right? So if I say that we're going to have a 6% assumption, I need less money than if I say we need a 5% assumption. Fair? Mm-hmm. Right? And so when I lower the amount of my expectation, you've got to put more money into your pension fund. Now, as a board of directors, as a CEO, Angi, do you want to hear that you have to put more money in or less?
Less.
Yep, less. Mm-hmm. Right. So one of the expressions we use is everybody's on the wrong side of the deal, right? As the money manager, I want to get paid to manage your money. I don't want to give you a disappointing number. So I'm going to tend to inflate my expected rate of return. And on the other side of the table, the CEO and the board of directors want me to inflate said number, right? Which means, by definition, I have an assumption that I'm probably not able to get to. So if you listen to the Market Carver, which you can get signed up for, it's a freebie that we send out every week, and you can go to yourlifeafterwork.com to get signed up for that. But if you go back earlier this year, and it could have been late last year, COVID has kind of messed with me a little bit. But you can go back and look at it. But the state of California went from a 5.75% assumption down to, I believe, a 5.25%. And I think it was the last 5 years, maybe longer, they've not gone over 4.5% in terms of their actual rate of return. But when they moved it from a 4.75 to a 4.25, it cost them $500 million worth of excess taxes that they had to put into the pension fund. Wow. Right? So suddenly politicians have $500 million less that they can use to make people happy, right? You still have an underfunded pension. Nothing really changed other than a money manager changed something on paper. And that's really what happens in this game.
Well, when there's an acquisition, though, I mean, are you a new employee to the buyer? I mean, is your old plan terminated? How does that work?
It depends. And part of that, there are 6 letters that Joe will not mess with. SECDOL, right? The Securities and Exchange Commission and the Department of Labor. Those are just bad people to battle. And so what happens is if I buy another financial planning firm and they have a 401k, their 401ks will merge into our 401ks and everything will be fine. If we bought a printing company, that's not necessarily the case. That would be like having another stream of income, if you will. So it can be dramatically different. And it's why you've seen in your career at the Financial Enhancement Group, it's why you've seen people who have been able to merge with other companies, right? We're having it right now with people who were at GE who got sold off in the medical device side. Are they still under the GE label, or are they not under the GE label? And do their pension funds travel? And there are big arguments over that.
We have a question come in, and by the way, it is Grant, who's one of our senior advisors in both Anderson and Indianapolis office, and Brownsburg. He'll go anywhere. So, okay, here's the question. A big corporation bought the smaller company I work for currently. What should I do with the 401k, and what should I do with my small pension plan?
All right, so there's 2 different questions. With the 401k, the first thing you want to do are find out the options at the new plan. Does the new plan have a Roth option? Does it have really good investment options? There are still companies out there, and I have that they don't, as employers, do not understand the liability that they are accepting by having insurance companies, in my opinion, as a fiduciary, they're having insurance companies manage their 401k plans. And there are hidden fees and expenses, 1% to 2%, sometimes more, that are inside of those plans that those employers are allowing to occur. I believe they will be unhappy when all this rolls out. So if I was moving into a new company and it was like our 401k plan, I would look to see the amount of money that I had, right? The good news about having money outside of a 401k is you get to make the choices in terms of how the investments are. Like at us at TD Ameritrade, there are no trading costs any longer, right? So the size of the account doesn't matter as much anymore as long as you're remaining focused in terms of what you're doing. So if I only had $3, $5, $10, $15,000, I would probably roll it into the new 401k. If I had 50, 100, 250, $500,000, I would probably roll that into an IRA so that I'd have better control over where the investments were.
And I know there's a lot of considerations for that because we've had that happen so many times with companies who've come to us who've had a plan end, and now they've gotten some kind of letter and saying, okay, you have so many days to either roll into the new 401k or roll out into an IRA. And I've noticed when I've gone to those meetings, you don't necessarily say one or the other. You have a list of questions that you ask those people.
There's a checklist. I mean, you really want to go down and think about what those questions are for each and every one of us, right? But you really want to go down the list and go, okay. And a big part of it is your age, what the options are inside of the other plan, who the custodian or administrator is, what options that they have in terms of Roth and non-Roth and in-service non-hardship distribution rules, what those are. But there's things you really want to consider.
What
And
about
another
your
one's
health?
how attentive you are.
Would your health matter?
Your health wouldn't necessarily matter in that one as much as it would in some of the other conversations. The in-service non-hardship distribution rules apply to people that are over 59 and a half, in some cases over 50 if you're at some companies. But they're age-based things. Disability is one of those 10% exemption things on a 401k. So if your health was really bad enough, then the 10% penalty is waived.
What if you decided to roll into the new 401k plan, but the new plan does not have a Roth option and you've had a Roth option before?
I've never seen that happen.
Well, what if it did?
I there's a reason I
I mean,
said I've
so
never.
basically some employers don't offer the Roth option,
It's
right?
you're still less than 66% of the companies out there that have the Roth option.
So if you went to work somewhere new and this new company says, hey, our 401k plan has a Roth option, and you were like, oh, because I was going to take my old one and roll it in, but it's not a Roth.
If you had a Roth already, if you were in a company that had a Roth 401k, that already tells me a couple things. One, you're more astute than your neighbor, right? Because you've already figured out that you need to be doing some tax planning. The second thing is you probably came from a bigger company. Other than, at FEG, we've had a Roth. I've put zero money into a 401k until it could be a Roth. I hide nothing about that. I'll make it public all day long. The idea of tax deferral in a world where you think you're going to do better the next year than this year makes no sense to me. So I don't think that would happen. I mean, you're talking about a smaller company taking out a bigger for the majority of the time, Angie. But I would roll. I mean, obviously, if it didn't roll into the Roth side, you'd roll it into a Roth IRA, and you always have that option, guys. Remember, if you leave if you move from one workforce to another, from one company to another, almost always you have the ability to move your money unless it's the exact same industry. If Ford bought General Motors, then you're stuck. But for the most part, you have an opportunity to be able to do something there and maneuver your money around.
Well, we do have a checklist on our website at yourlifeafterwork.com. The checklist is about company buyouts or mergers and acquisitions, and it has a checklist of things to consider if you've gotten that letter or have to make that choice.
800-928-4001. We'll be right back. Yeah, it's those are great questions, Ange. It's I'm gonna have to get on my tippy toes to prepare for you next time. Are these next questions this difficult?
No, you know this in your sleep
Oh.
because we're talking about certainties in life, death and taxes, but we're talking about RMDs. Those are certain.
You're right. I probably do know most of those things. Anyhow, it's we appreciate the questions, guys. Keep them coming. Grant, glad you're out there, buddy. Go ahead, Case. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angi Kinser.
And apparently, Angi wants to talk about required minimum distribution.
Another certainty in life.
It is a certainty.
If you make it to age 72, you're going to have to take RMDs.
Now, you said 72, so tell me why it's 72.
Well, it used to be 70 and a half.
Okay.
And it was changed. So I'm just saying that you...
Changed when?
Last year.
December 20th
Yes.
of last year.
Yes.
Right? So it used to be, for those of you that are listening, and this is important. I mean, some of you are going, Joe, this is boring. Some of you, I mean, people miss this stuff all the time. It used to be the year after the year in which you turned 70 and a half, but if you didn't take it that year, you had to take 2 the next year, the first being before April 1st, or you endured a 50% penalty. The IRS decided that was a little complex. You think?
Yeah.
Right? So now it's age 72.
Well, I mean, RMD rules are so confusing, and
Archaic would be a good word.
but the penalty is very clear.
50. 50. Now, this is one of those penalties that the IRS is pretty good about. If you tell on yourself, they're pretty good about waiving. So if you didn't take an RMD in 2019 and you took it in 2020 because you realized you failed to make the distribution because of, all sorts of reasons. Sometimes people just forget. But the penalty of the 50% of what you should have taken out, if you tell on yourself and take the distribution in the next year, as far as I know, the IRS has never imposed that penalty.
Okay.
They seem to be pretty lenient there.
So what happens if a person dies before taking an RMD?
So if it's so you have a couple of things. You have this RBD, right, which stands for retired, the retired beginning date. When somebody passes away, they have to take, if they're supposed to take an RMD that year, they are supposed to take it.
Okay.
Before the account's transferred. Now, why does that matter? If mom and dad are broke and they have a small 401k and you're a neurosurgeon and you're making a lot of money, you would just assume the taxes be paid on mom and dad's return for the RMD. The reverse is also true, right? There are times when you'd prefer to have the RMD taxed at the kids' level, not at mom and dad's, especially if you're going to do a generation skip and send it to the grandkids, where maybe they're in college and are have zero taxable income. So you have to pay attention to both sides of that equation in terms of where you are. But the rule's pretty clear. If I die and I've passed my required beginning date, so I'm 72 or over, the RMD has to be removed from my account prior to the money being transferred to the next generation, unless it's my spouse. If it's my spouse, there's a different story because spouses have entirely different rules.
I was going to ask that. If it's an inherited RMD, are you charged?
Well, it wouldn't be an inherited yet, right? I died. So what you don't have an inherited RMD. You have an inherited IRA.
Yes.
So
those
are two different things.
Okay.
The RMD has to stay with me.
Yes.
Even though I'm dead.
Okay. But the people who are left that have to pay it for you on the year that you die.
They don't have to pay.
Not take it, not pay
Well, no, because they actually took it. So it's a great point, Angie. And don't get frustrated with me, but I mean, this is something that people forget. The year you die, you file 2 tax returns. Now, obviously, you don't do it, but Barb would have to do it for me.
Right.
Somebody's got to file a 706. That's my final tax return. And somebody files my final 1040. So the RMD left, if I was 72 or older, the RMD is taxable on our return, assuming Barb's still alive. Nothing matters because it becomes a spousal IRA. Let's assume Barb was gone already.
Okay.
Right? I'm still taking the RMD in my name on my tax return, and Kaylee and Kendra will inherit the IRA and 401k.
Okay.
Does that make sense?
Yep.
Okay.
Yep. Okay. Now, can you reinvest in RMD? I mean, do you?
You can sure you can. I mean, once you've got the cash, so the IRS only cares about the taxation. So the money leaves the IRA, you pay the taxes on it, and then you can reinvest it. It doesn't mean you can put it back in the IRA or a 401k or even a Roth IRA. All it means is the money came out, it got taxed, and whatever the proceeds are, you're free to do whatever you want to do with. Go to Vegas, right? Go on vacation, or put it into an investment account.
Is there a way at all, to keep RMDs from being taxed? Any
The only
charitable?
the only way, and that's it. It's the only way to keep an RMD from being taxable, short of COVID. So 2020 was a weird year. The IRS ruled that you didn't have to take RMDs this year. Other than that, the only thing you have is what's called a qualified charitable distribution, or QCD, where you had the ability to send the money directly from your IRA. Notice I didn't say 401k or 403b, often confused, right? Has to come from an IRA, and it can go directly to a charity. So somebody asked me 2 weeks ago, maybe 3 now, I've got money in a 401k. Why can't I give to a QCD? And I said, because I'm not in the legislature. I can't fix the rules. I can only tell you what the rules are. However, when you're in this case, he was 76 or 77. I said, what we can do is take money from that 401k that for some unknown reason you want to keep, right? And he likes the money at the custodian and where it's at. So I told him to move the amount of money that he wanted to make in a gift. By the way, a QCD is up to $100,000 a year. It's not limited to your RMD. So in his case, he moved, I think it was $28,000 from his 401k to an IRA, and then the IRA made the distribution to the QCD, to a qualified charitable distribution. He won't pay any taxes on the $28,000. The charity doesn't pay any taxes on the $28,000, and he satisfied his RMD, even though he didn't have any for 2020 because it's waived for this year.
Got it. We're going to switch gears for just a second because a question came in late from the previous segment. Have larger investment firms tried to buy FEG?
Do I have to answer that question?
I don't know. That's up to you.
Every week. We get at least a call a week where somebody is trying to acquire us, and I've got 4 partners. Adam Harder, our CFA and Chief Investment Officer. Aaron Rayomes, our Director of Financial Planning. Don Hodson was the co-founder and our Chief Compliance Officer. And Taylor Jenkinson was one of my students at Purdue. Our youngest partner is in charge of our paraplanning division. I have no intentions of selling, or I would have a long time ago. But to say that nobody tries would be a fib. And we have to get evaluation every year because that's what the SEC mandates for succession planning.
Okay. Well, we want to answer every question, but here's a question for this segment. Does it still make sense to do QCDs this year?
Absolutely. Oh, absolutely. Because especially if you're a big giver, because you can only give away $100,000 a year. So let's say you've got $1 million 401k and you intend to give away $100,000 a year. And especially if you're in your higher 80s, your RMD could very easily be getting in some of those larger numbers. So to give away the $100,000 this year, or to give away the charitable gift this year, makes a lot of sense. The second thing is charities are suffering this year. There's a lot of people who simply don't have the money to make giving. Now, when I look at our church and I look at some of the other numbers, we've got a big powwow with our church. I think it's next Wednesday or the Wednesday after that. The people that are giving $200 to $500 a year are almost gone, right? And those numbers add up. I mean, they just do. People who've been making larger gifts for years are still making larger gifts. But yeah, I would not wipe off or eliminate the desire to do a QCD this year just because you don't have to have an RMD.
So, okay. What about Roths? I mean, could you take a QCD and put it into a Roth?
No. So a QCD is a qualified charitable distribution. A Roth is money that you've already paid taxes on. So a Roth is never anything you do a QCD with, right? When you go to make a charitable contribution, you're wanting to do it out of something where hopefully you're getting a tax benefit. Now, with the changes in the standard deduction versus the itemized deduction, It's not as easy if you're not able to deduct, which is why the QCD is so helpful, right? You don't have to do a standard, you don't have to do an itemized deduction and get the impact or the advantage of a QCD because it's going directly to the charity. You don't pay taxes on it. You don't get a write-off. Everything's good. Give me my standard deduction. We'll go home and play euchre and be happy. When you're looking at this from a standpoint of a Roth, it makes no sense to do the QCD, right?
I'm laughing because there's too many abbreviations. What I meant to say is, can you take your RMD and put it into a Roth?
Oh,
So
in theory, if you had a job, you have to have earned income to make a Roth contribution. In theory, you're 84, you're working, you're making money, you take out the RMD, you're going to have to pay taxes on it. But in theory, you could use the remaining amount of money to make the Roth contribution.
yes.
But you do have to have earned income. Can you take an RMD and put it directly to a Roth in terms of a conversion or contribution? The answer is no.
Have to have that earned
You do have
income.
to pay taxes.
You have to be
Hey, Angie's asked some really great questions tonight, but do you want to talk to her some more? You can give her a call at 800-928-4001. Get signed up for a Next Steps meeting. Come in, sit down with one of our team. They'll give you the same answers I will. And here's the deal. We will tell you what you need to consider today, things you're going to want to consider in the future. And if we choose to partner together, we're going to give you things that FEG will do for you. And more importantly, we'll put them into writing. And that's kind of the way the plan and the system works together. 800-928-4001. Give Angie a call. We'll take a break and be right back. Those really were some...
Interesting
I
questions.
may have to study before the next one.
Yes.
For a minute.
Well, we're in our last segment, still in certainties of life. So now we're going to talk more about the defined distribution. We're going to talk about when it's time to retire, you can't run or hide from the IRS. And I'll say more when we go on live.
Casey, is it actually you or am I making this up?
We don't know. It's
All right.
Levi, gosh.
Well,
Dang
I've been giving Casey credit, and then I realized last time I was saying like, wait a minute, no, that finally is Casey.
It was
Yeah.
Jen when you were giving Casey credit last time, and now it's Levi.
All right, Levi, here we go, buddy. Well, good morning and welcome back to Consider This Program. I am your host, Joe Clark.
And I'm Angi Kinser. So, still, we're talking about certainties in life, which generally relates to death and taxes.
And coffee. Oh, wait, no, that's not a certainty, is it?
Death, taxes, and RMDs.
And coffee.
And coffee. And so, this segment is going to be when it's time to retire, you can't run or hide from the IRS because there will come a day when the IRS is at your door to collect. Distribution of your retirement assets can be by your design or theirs.
So those are great words.
Yes, I hear you say them all the time. That's why I
It's
stole them and used
It is
them.
my purpose. It is my passion. It is my frustration. So what do you mean the IRS is coming?
Well, at some point, all of your deferred money that you have saved, you're going to have to pay taxes on.
And you've been here for 8 years. Did you understand that when you started?
Probably not. No, because, I mean, that's deferred tax money's just been going on since when?
1978.
1978. So
Approximately.
I know that back at that time, interest rates were so high that it made sense.
Not interest rates. It had nothing to do with interest rates. It had to do with the tax rate.
Tax rate. Tax rates were so
when
high.
When Reagan took office in 1980, the top tax rate was 70%. Right? When
Yes.
Kennedy took office, the tax rate was actually even higher. Right?
What's the top rate now?
37 and change, 37.6.
Okie doke. So back at that time, it made sense to not have to pay your
So
taxes
there's
right now.
and somebody's going to be out there going, yeah, you forgot about the 3.8 Medicare. Da, 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 da. I mean, it's high, but it's nowhere near as high as it was.
So is there always, so now we've put away all this money into retirement, and at some point,
You will pull it out.
you will pull it out.
And so the theory back when all of this was crafted, was that you deferred the taxation today because you would need less money later on in life to be able to retire. Now, this is probably not what Angi wants this segment to be about, but just hear me and pay attention to this. When you go to retire, it is the successful retirement is about replacing 100% of your standard of living, not replacing a percentage of your income. So if you make $200,000 a year and you live on $20,000 a year, your tax rate will go down until these blasted RMDs kick into place. Right? So, and here's where people really get into trouble, Angi. What they'll do is they'll say, okay, I don't need that amount of money to maintain my standard of living, and so I'm going to defer my taxes. Perfect, right? So we defer taxes because you expect your tax rate to be lower. Well, that's true. But unless any of you that are listening to the show agree to die on time, that's kind of humor. Unless any of you agree to die on time, that's 84 and a half if you're looking at Social Security. It's 72 if you're not afraid of RMDs. Unless you're willing to die on time, you're going to be forced to have a defined distribution established by the Internal Revenue Service, not by your own making. And so just because you're going to make less money later in life does not make deferring taxation still a right idea. And when you sit down with planners and CPAs, and for the record, CPAs, in my opinion, get this wrong more than the planners do. The CPAs are, I've had multiple CPAs tell me that is assuming my tax rate was the same across the board, it didn't change, and the rate of return didn't change, it didn't matter if I Rothed or didn't Roth. They don't understand that me or Barb will die. And once you take that out on an Excel spreadsheet and you recognize that a spouse will pass away, your computation has to become different. We do not understand what is happening to us with RMDs that we have self-imposed because of the rules that are out there. Oh, I'll get off my soapbox now, but it's that's, you know, I will spend the rest of my life being a trustee for people to help them understand how to best distribute their assets. But the second part of that is understanding how these distributions work, and ladies and gentlemen, it's not good news. It feels good on one side, and it really feels bad on the other.
So a lot of times we'll have there's a penalty if you take it out early, if you go into distribution early.
Yeah, but we don't. So, keep going. I didn't mean to interrupt. I'm sorry.
Is there always a penalty for getting your money out early, or are there ways that you can do that?
Okay, so you can get money out of a 401k if you're 55 and younger and the plan allows for it and you don't have higher earned income. In an IRA, you have to be 59 and a half or older to be able to get it out. That's true across the board. There is a rule that is called a 72T that stands for, and do not miss a word in the sentence. Mm-hmm. Are you ready?
Ready.
Substantially equal periodic payments unchanged for the greater of 5 years or 59 and a half. Miss a word and welcome to the penalty, right? So you either have to be in a 401k and be over 55 and not have a lot of earned income. You have to be over 59 and a half. And on all we're talking about here, this has nothing to do with the tax, ladies and gentlemen. This has to do with the penalty, right? You either have to be over 55 in a 401k, over 59 and a half in an IRA, or you can do a 72T. So let me give you those words again, and don't miss one of them. Substantially equal periodic payments unchanged for the greater of 5 years or 59 and a half. So, Angi, if I'm 50 and I do a 72T, how long do I have to take the money?
Till you're 59 and a half?
59 and a half, right? That's 9.5 years. That's not 5, right? So, and people miss this. And we had a guy who moved his account from Morgan Stanley to FEG that was doing a 72T. He was 59 and 5 months. Didn't tell me he was doing a 72T. 59 and 5 months. where do you think the 10% penalty goes back to? This is me looking at Angi.
Oh, I don't know.
From the very first distribution that he took at 48 years old.
Yeah.
So it goes all the way back, in his case, 11 years, 10% of all of those, because he took the money out, I think it was 27 days early. So we try to discourage 72 Ts, that ruling, if you will. We're very, very careful to help people construct their defined distribution. If you've got a 401k plan and an IRA plan, how you use both of those. A lot of people worry about creditor protection because they've read some crazy articles that are written from other states. Indiana is not a litigious state, so we don't really endure a lot of these like other places do, and a lot of this stuff's protected. But there are still things to consider.
Is there any way to get money out of your 401k before you're 59 and a half that you can put in an IRA?
If you have a company plan that allows it, there is a provision called an in-service. That means you're still working. Non-hardship, meaning nothing's wrong. Distribution, that allows you to roll money directly to an IRA. Now, the better question, I think, Angi, is why would you ever want to do that? And that's really where you get into 401k plans that have really lousy provisions, right? They don't have a Roth option. They don't, they're just lousy. It's managed by an insurance company, and the internal fees and expenses are just too high. It's those kind of things.
So it makes sense to ask, at least if you qualify for that.
One of the first things we do when we have a next steps meeting is if you come in and you're over 50, because there are places that are listening to me tonight that are, or this morning, wherever you are, that have companies that allow for an in-service non-hardship distribution for people that are over 50. Most plans will always do that at 59 and a half, but not all of them. And so that's one of the first questions we look at is, should we be moving money? Now, should you take money from your 401k to move it to an annuity because your next door neighbor's kid sells annuities? No. That is not what I'm advocating.
Speaking of that, I got a question. I retired and I got an annuity to replace 100% of my income. Things are good. What should I consider in the future? Why may this not have been the best idea?
Well, so some people say the word annuity and they mean pension. So it depends without knowing your particular things. The question is what you want to give away, right? So if Barb and I had no kids and we cared about having nothing left, all we wanted was income, then it may make sense to do a pension or an annuity type structure. But we do have kids. We do have charities. We do have dogs. A dog in this case right now. We do have people we want to leave money behind to, right? So if you do an annuity or a pension, typically when you're gone, it's gone. And so that's one of the equations. So that's where the uniqueness of planning really comes into play. What makes the most sense for one person is not necessarily what's right for your neighbor. And you need to be aware of that when you're at the coffee shop chatting.
We'll save our question from Cindy for our exit because we just have a minute here, but I wanted to ask you real quickly. Would the IRS, would they owe you back if they didn't send your refund in time?
Would they? No. Actually, there was a case. When was that?
I think
it was a couple years ago where they were actually going to pay us interest.
Yes.
And that's the first time I'd ever heard about that, ever.
I saw an article that said the IRS may owe you interest.
Yeah.
That's why I brought that question up.
You thought you were going to trip me
No,
up,
I
didn't
didn't
you?
even-
No, you did.
I actually did not read the article.
See
I thought
her
I would
look.
ask you.
You ought to see her look.
Yeah.
Typically, that is not the case, and that's one of our statements on withholding. Is you're letting the IRS take your money, not pay interest, and giving you back an interest-free loan later on in your life.
Yes.
So, hey, giving Angi a call, 800-928-4001. Come meet my planning team. They do great work. Grant's online. He's happy to talk to you right now. 800-928-4001. We'll tell you things you need to consider today, things to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it in writing. 800-928-4001.
Okie dokie. That was 4. I thought for our outro, you want to cover this question by Cindy?
Sure. Okay. I'm happy to do that. All right, Levi. Except it shouldn't say 12. There we go.
Yes.
Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I'm Angi Kinser. We had a question come in right at the end from Cindy, and it said, if I have a trust, when I pass away, can my trustee decide to distribute my assets over a period of years, or is there just a one-time limit?
Depends what your trust says, Cindy. And this is really why you hire people like me to be a trustee. So understand we have a vested interest, right? So part of the challenge that I have with my industry is we get paid to hoard assets. And if there's anything that FEG does that makes me proud of who we are, it's that we teach you to use your assets. We teach you to spend them. We teach you how to buy cars, how to go on vacation, how to take care of your kids, how to have better Christmases. God did not put me here to help you hoard money, but I get paid to manage money. When I tell you that we have $552 million in assets under management, as of right now, we do. We get paid based on that amount of money. But I want people to be able to use what it is they have. And part of my frustration in life is the number of 90-year-olds that I've taken care of for 3 decades that now have a lot of money and not a lot of life left. Right? So we want to try to help people use that. So you have to understand there is a vested interest in Wall Street trying to help you hoard, right? And that's not what I want to do. So go ahead and ask your question one more time so I can make sure that I get the answer correctly.
Okay. If I have a trust when I pass away, can my trustee decide to distribute my assets?
Yeah, I just want to make sure I wasn't taking it where I wanted to go and not where you wanted to go. So it depends what's inside of the trust, Cindy. When I'm a trustee, most trusts read that we can distribute money for health, education, maintenance, and support. It's what we call the HIMSS clause. Sometimes we have special powers of appointment where we can distribute excess amounts of money if we deem as a trustee appropriate for that. Sometimes my trust says the kids get money over a period of time based on their age. So they have to be a certain age when I die. And then it's distributed over a 10-year period of time so that they have multiple chances to mess up. And it's also protected from marital and creditor protection. So it really, really depends. There's not a lot you can't do in a trust. You just have to have somebody who designs that trust appropriately and correctly. And please keep in mind, I'm not an attorney. I don't play one on TV or radio. We work with really smart attorneys. 800-928-4001. I hope you guys have a great week. Thanks for being with us. Look forward to seeing you soon. Hey guys, thanks for the show. Angi, those were probably the best questions you've ever asked.
You think?
Yeah.
We didn't even get through
half
of them.
I just want you to know. I'm just
okay.
It's been a long week, but those were great questions, and we appreciate you guys all being along. If you got anything you want to know, do not hesitate to call Angi and ask her. She knows a lot. No, just kidding. She does know a lot,
What?
but we're happy to help you in any way we can. We appreciate you tuning in. Have a great week, my friends.